Brian, for a long time now, you and your team at BMO Capital Markets have been saying we're in the midst of a 20 to 25-year bull market, and that March of 2020 was a reset. So how much of that belief and conviction in this bull market is a belief in human ingenuity within great companies like the Microsofts of the world to be able to continue to innovate and be resilient and grow, especially in the U.S.?
I think that people really, number one, underestimate the importance of technology companies in particular across each of the 11 sectors of the market. But more than anything, really underestimate how wonderful and strongly able to pivot companies and people were, in particular, during the COVID-19 pandemic, that they pivoted in terms of how they ran their life, how they lived their life, how they did their jobs. And it starts and stops with technology and continued innovation. You cannot have innovation, Mark, without having cash and research and development. And so I've said for a long time in my 31 plus year career, follow the cash. And you want to follow those companies that have the wherewithal and the ability to pivot. And so obviously technology is the quintessential sector that exemplifies that, but so too are retailers or restaurants, in financial services for that matter. And so I think those are going to be continued trends and themes, no matter what happens in the economy and no matter what happens with the pandemic. And we're off to the races in terms of new efficiencies, and they're not going to go away anytime soon.
Now, a lot of what we're seeing in technology now, the groundwork was laid, let's say 20 years ago, but then you had the tech crash, then you had the great financial crisis or great recession, whatever you want to call it. And you said that ever since then, so many investors and even clients have just hated stocks. And to this day, there are those who are still negative about investing in stocks and they're gun shy. So can you explain that mentality whereby investors keep looking in the rear view mirror instead of looking forward?
It's a great question, and it really does harken back to the late 90s. And I mean, we can go back even further than that, but I really think it's easier to discuss the capacity-led recession that was really about technology. People forget that in 1999, remember, we thought in some circles that the power was going to go off and that all these things were going to happen. So guess what? Go load up on your technology. It was your classic oversupply of technology companies. And they got too fat and happy and a little bit too cocky with respect to how they were running and how they're being valued. And I think a lot of investors put too much solace in analysts and companies alike with respect to the stories and the banking and all of that kind of stuff. And it really put an eyesore on equity investing in general, Mark. And then after the capacity-led recession from technology in 2000, 2001, and the resulting kind of buy the dip craze that did not work in technology stocks, during that time frame also, you had the advent and reality of the euro, moving from a synthetic currency to a real currency in 1999. You had oil prices hitting multi-decade lows. You had emerging markets. We really began to prosper due to supply chain changes in terms of manufacturing and growth there. And so the story was anywhere and everywhere else but the US. And you also dovetail that with respect to the negative eyesore of investing in general, especially in equities. Then you segue into the great financial crisis, which was another I think, simplification of what happened. You had a credit recession and a consumer recession at the same time, which they rarely happen. And the financial sector and financial people were the bad people. And we became very emotional about that. And then the last 10 or 12 years, we've had this bull market, which we actually started to call in 2009 and then segued our call in 2010 to a 20 to 25 year bull market into this, use your phrase, climbing the wall of worry, most hated bull market in history. We've been saying it for years, and it just continues, Mark. And I think it continues because we're so afraid to be wrong. We don't want to be right. And that is exemplified also with the way that people are managing money. People, I mean, by hedge funds or traditional money managers, they become much too formulaic much too academic. And I've always said that investing's like life. If you're running your life by a formula, but it has to all add up to Z and double underline it at the bottom of the sheet, I think you're going to have problems. And I think that's why many investors have kind of missed this big move in the markets and clearly missed what I like to call the Control-Alt-Delete reset of the bull market, which I think is going to be different the next 10 years than what has transpired the last 10 years.
You mentioned academics, and you've been critical of macro strategists as well the last while, saying that they've been wrong in a general sense for quite a while now, and many of them are calling for a crash again in the markets. We've seen the peak, and we're seeing euphoria, but you're calling for and seeing unprecedented earnings growth. You think the economy is not going to normalize for another 2 to 3 years. So how do you reconcile that disconnect where you've got that one faction saying, oh, this is it, it's got to be a crash, and you're saying, no, it's going to keep going?
Fear sells, Mark. Fear sells. And what's interesting about let's call them fear mongers or negative Nellies or whatever you'd like to label them, they're exquisitely eloquent. They are backed with reams of data, and they look to the past for future. And I think that it can never be told any clearer than what happened in February, March of 2020, when many of these same people were saying that we're going into the next Great Depression, that we're going to have 40 to 50% negative GDP, all of these, what I like to call bombastically negative calls. And they really did not take into account how strong human beings are and how elastic companies are. And I said it on March 23rd, and I still say it today. We have the best companies in the world here in North America, both Canada and the United States. And it's the wherewithal of fundamentals that really work. Another way to say it is, faith overcomes fear. And what's faith in investing? It's fundamentals. And the fundamental construct of both the Canadian and U.S. stock market, we think from an asset perspective, remains very strong, and we think that's where investors should be invested.
You said, Brian, that you've been in the investment game for more than 30 years now, and all that time, we haven't really meaningfully seen inflation, although there have been numerous calls over those years that inflation is coming, especially now, although the bond market is starting to tell us otherwise. But what do you say to investors in terms of trusting the Fed when they say, this inflation we may be seeing in certain pockets is transitory?
I think the problem with many macro observers is they try to be the smartest person in the room. I think the smartest person in the room is the Fed. And so let's listen to them until proven otherwise, number one. Number two, chairman of the Fed in 1982, Paul Volcker, got together with President Reagan and Speaker of the House, Tip O'Neill, over a large bottle of scotch and decided to change the course of the economy in the United States and for the world for that matter. Many people don't remember that we are in the midst of a potential double-digit recession in 1981-82. And so Mr. Reagan and Mr. Volcker to cut rates and agree for Mr. O'Neill to help cut taxes, and that was it. So what does that speak to inflation? That's really what changed things. And so I think the academic measure of inflation clearly can be debated all day long. And I think academics really kind of get in the way sometimes because it clouds what's happening. I think, again, investing is kind of like life in real life. But think of the innovation that we've seen in this world and in Canada and the United States just the last 12 to 18 months. Speaking of inflation and what the bond market is telling us, we've had a near 40-year bull market now in bonds with yields falling the way that they have. And I think if we would have came back and did this interview in February or March, a lot of people were talking about 2% or 2.25 on the 10-year Treasury with respect to interest rates, and that's just not going to happen. And we were saying that at that time that this notion of high inflation for just saying high inflation is moot. And I think what the bond market is telling us is that growth is going to slow probably, but not to the point where we're going to see a recession or any kind of stagflation. And I think at the end of the day, until we start to see substantive wage inflation, Mark, I think this is going to maintain this type of low interest rate environment that, oh, by the way, double-digit earnings growth, low interest rates, and multiples that have contracted are a very good backdrop for equities.
Now, you've been covering Canadian stocks for nearly 10 years now, and you say that Canadian stocks often have a negative cloud over them. Why is that? And have you noticed, and do you notice a difference in the mentality of the U.S. investors versus Canadian investors?
I have, and I've been coming to Canada to speak to institutional investors for well over 20 years, but at that point, it was only the U.S. strategists at different firms. And since I've been at BMO, I've learned a lot about Canadian stocks and Canadian sectors, obviously, and that's my job. And I mean no disrespect, but I've said that Canadian investors are the moral equivalent of the mythical creature Eeyore from Winnie the Pooh. And maybe it's the weather, maybe it's, I'm from Minnesota, so I kind of share the same type of passive aggressive behavior. But listen, I think that the negative tone is just they're afraid to be wrong. And I think Canada, because of the relationship with the United States, and the proximity and the GDP relationship and the earnings relationship kind of feels like the smaller brother, and it shouldn't, because there's so many great companies in Canada, so many great opportunities, and we really witnessed this firsthand in terms of the negativity and fear factor last year during the pandemic. Now, in the beginning of the market rally in March and April, Canada was keeping pace with the United States, and then as large cap stocks and technology stocks in America kind of really started to take over, Canada began to fall off. Be that as it may, the biggest fear that we were encountering when oil prices were low, that the Canadian banks were not going to pay dividends anymore. And I can't tell you how many research notes we wrote and how many client conversations that we had, kind of taking people off the ledge saying, banks are not going to cut dividends. In fact, they're most likely, based on what they've done historically and during times of duress, to over reserve and then have excess capital several months down the line when economic conditions and bank conditions would stabilize. That's exactly what has occurred. In fact, now you have many of the Canadian banks flush with cash, over reserve, talking about even stronger buybacks and stronger dividends. So Canada's dividend lineage comes back to a lot of what happened in the UK. And I found that income investors in Canada are very good investors, but I think they got too nervous and too negative just because of, I believe, this too negative fear a led mantra that it really encapsulates Canadian investors, especially relative to U.S.
And you've said, Brian, that financials are massively underowned. Is that still the case? And what is it about the so-called money center banks, the Bank of Americas of the world, even in Canada, the BMOs, the TDs, the RBCs, that make those the ones the investors should be paying attention to and investing in?
Well, I think the banks in particular and the financials are still hurt by the great financial crisis, because everyone decided that financials are, bad people that work there and all that kind of stuff. In fact, I used to tell people I was a consultant for a while during the financial crisis because people wouldn't talk to me because they knew I worked at Merrill Lynch. But be that as it may, we believe many of the Canadian banks, including BMO, RBC, and TD, benefit from this theme of scale. Scale is an important theme in financials. And that's why money center banks like JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America benefit, because they have multi-divisional assets. Or sometimes the commercial bank will do very well. Sometimes wealth management do very well. Sometimes the capital markets side will do very well. We've seen from the personal banking side, there's going to be a massive transition, we believe, from the branch system and assets and how they're managed going forward, potentially even more so to a direct-to-consumer type of model. That's all where financials are going. But that benefits these larger companies, Mark, because they have the balance sheets, they have the wherewithal, and it goes back to what I said in the very beginning in terms of follow the cash. And so I think regional banks, smaller banks, are not going to have the opportunity to take advantage of that, because net interest margins are going to continue to be more compressed with what's gone on with the yield curve and with overall yield. So that's why we like the money center banks. And we still think that there's a great investment opportunity, especially for those those investors that are looking for growth in terms of stability of earnings, and especially dividend growth.
Now, in May, you and your team upped your TSX year-end target to 20,500, almost got there recently, and you upped your S&P 500 target to 4,500 year-end as well. Now, we know you like technology, communication services, you like to invest thematically as well. So take us through the end of the year, and where's the leadership going to come from, and what are the kinds of companies investors should be thinking about?
Well, I think what may change here is that we're transitioning into more of an earnings-driven fundamental market. And when you see earnings-driven markets, historically, the return structure changes a little bit relative to the momentum type markets that we've seen, namely, which really began in 2016, had fits and starts in 17, obviously in the fourth quarter of 2018 when we had the deep correction. 2019, I call it more of a repeat of 1995. And then obviously the unprecedented performance that we've seen since the March 23rd, 2020 lows. But those are momentum kind of price-driven markets. As we transition more to the economy and the companies begin to mature through this recovery, they'll be driven more by earnings. Doesn't mean that they're not going to be positive. It's just going to be kind of less positive and more stable, let's call that. Through that, we want investors to kind of tilt more toward quality. I know a lot of people talk about what quality is, but quality is the return structure of companies in terms of return on assets and return on equities improving, strong cash flow, strong balance sheets, and more important than anything, the consistency of earnings. And so through that, we think you should be broadly moderated in terms of your positions with respect to growth versus value and small, mid, and large cap stocks. We think should be equal weight across the board. And a lot of people tease us that doesn't add value, but we actually think it does, because earlier in the year you had this massive outperformance in value for a long time, for the first time in a long time, I'm sorry, but much of that outperformance, Mark, was due to these lower quality value stocks outperforming. Now we think we're going to see a shift to higher quality value stocks, i.e. Like the financials. And so I think the same thing holds true for growth stocks, which one of the most, if not the most consistent earner in the S&P 500 are technology stocks. And so I think that's going to continue and really lead performance for the rest of the year. And as we kind of segue into 2022, obviously the taper tantrum arguments will start. And I think that's against knowing the backdrop of when we're going to taper or how we're going to taper. I think quality and high quality across the board really dilutes that type of risk.